Hi everyone, a very good morning to you all guys. Uh, we are in between the merger and acquisition series where we are discussing the advanced questions. My name is Deepak Bisht and I will be presenting it to you today. So let's start with question number 10 onwards. Till question number 9 we have discussed, and for question number 9, though it was a difficult question, uh, I have done a small video where I have explained everything, every component of a goodwill, and how this formula is actually driven. So let's move to question number 10 onwards. So question number 10 is explain why would we write down the seller's existing deferred tax asset in a merger and acquisition deal? Okay, so think when you think about it, write down of deferred tax asset in a merger and acquisition deal. So this is one of those areas that frequently confuses even advanced analysts because it sites right at the intersection of the tax law and purchase accounting. So purchase accounting is actually IFRS 3 and tax laws are ASC 805. So let's talk about it carefully. So, so actually is a deferred tax? So first question is what actually is a deferred tax? And if you think about it, so it represents actually future tax benefits. So we have deferred something into future, then defer in definition means we have pushed something in for future. So this is representing future tax benefits and basically the amounts that can reduce the future taxable income. And if it's an asset and it's if says future, so this is a asset that we can use in future. So asset is something which benefits us, and liability is something which is actually a cost for us. So the deferred and asset means future and asset. This is an asset which we can use in future. So typically, deferred tax assets arises from net operating losses, which are carry forward, and because it was a loss previously, and we have carried it forward, so we can use it, and this actually can cause a deferred tax asset. Tax credit carry forwards also help creates a deferred tax asset, and the temporary difference between where expenses are recognized earlier for tax purpose than for book purpose, which could be created because of depreciation schedules. So if the seller's balance sheet, a DTA in a seller's balance sheet, DTA is essentially saying that in future I expect to pay less tax because I can use those losses or deductions. So, and the question, don't forget the question. The question is about why do we write down the deferred tax assets in a merger and acquisition deal? So why do we actually write down means we subtract kind of. So okay, so now understand this thing. So merger and acquisition creates a problem, and why does it creates a problem for deferred tax assets is when one company acquires another, we must ask, can the buyer actually use those tax benefits? And the answer depends heavily on the type of acquisition structure, if it's stock purchases or asset purchases, or and the tax law limits using net operating losses. And if you remember, we discussed about this in when we discussed about section 388 of IRS. So if the buyer cannot use the deferred tax asset, then it's no longer an asset, and it doesn't because it doesn't provide an economic benefit, and therefore accounting rules require us to write it down. So the post-deal balance sheet reflects only realizable tax benefits here. So that's one reason. And so basically there are two type of transaction keys, two types of key transaction types. Either it's an asset, either we have Either we have followed a asset purchase, or we have followed a stock based purchase. So if it's a asset purchase, the buyer buys the asset directly and not legal entity. So the buyer gets a stepped up tax basis. So there's going to be a stepped up tax basis, and in those assets, uh, which is greater for depreciation deductions actually. So basically, understand this. If I'm writing down a DTA, this means the seller gets 100% of DTA's balance, because net operating loss do not transfer. The seller's DTA is worth zero to the buyer. So we write down the DTA completely if it's a asset transaction, asset purchase. But if it's a stock purchase, so in a stock deal, the buyer actually purchases a share of the entity, and this means that the legal entity survives. So the and net operating losses and DTS technically stay with the company, and but the IRS also restricts how much of the net operating loss can be used per year after a change in ownership. So this restriction is governed by IRC section 382. Uh, and okay, so understand this thing one more time. If it's a tax-based, if it's an asset purchase, so we are only purchasing the asset, but the deferred tax asset is with the legal entity, not with the asset only. So the legal entity, this asset is only with the legal entity. So when we are only purchasing the asset, we will be writing it down. So don't get confused. If it's a stock purchase or a asset purchase, so the buyer steps up the tax basis of the asset, but the seller's net operating loss do not carry forward. So the entire DT is written off. But however, in this stock formula, in the stock purchases, so the legal entity remains intact. So the net operating losses survive, and IRS, because of the IRS limitation, you can only write down a certain portion of the net operating losses each year. So it calculates, okay, so it's written here that essentially this calculates the portion of the DTA that cannot be used before the net operating loss expires. If the buyer can use all the net operating losses, nothing is written down. If not, the excess is reduced. And okay, if we talk about the practical formula, uh, okay, let's discuss about the conceptual rationale. So why does it matter? And writing down, so writing down the DTA ensures that the acquirer's post deal balance sheet only reflects assets with the real economic value, and goodwill also. So from a perspective of goodwill, so goodwill properly captures the cost of assets that cannot be recognized separately. So if we have already captured that cost, that the asset cannot be recognized separately, so why would be we needing a DTA on the balance sheet in the first place? And from the tax perspective, the effective tax rate projection in the financial models are realistic. And from a valuation standpoint, so overestimating usable net operating losses can artificially inflate the free cash flows and the target's value. So this adjustment is critical for accurate modeling. And when when we talk about the formula here in the stock purchases formula, so DTA is written down, but how much and how? So the buyer's tax rate and the maximum of zero or the net operating loss, we subtract the allowed annual net operating usage into the expiration period in the years. So maximum of this or zero. So buyer's tax rate, we multiply it with max of zero or the net operating balance minus the allowed annual net operating usage into expiration periods in year. So here the formula is also here. So DTS value decreases with time, and net operating losses do not, we would try not to carry forward net operating losses, and we will try to adjust those DTAs and net operating losses as much as possible in our goodwill. But s- it would it would the it would depend on the kind of transaction which has happened. So if it's a asset purchase transaction or a stock purchase transaction, if it's a stock purchase transaction, so we will write down the DTA like this. So the buyer's tax rate into the maximum of zero or the net operating loss, whichever is maximum, net operating loss minus allowed annual net operating usage. If this number comes out to be negative, then we will use zero. And if this number comes out to be positive, so then only we will do that. Understand this thing, don't get confused. If the net operating loss and the allowed net annual net operating loss usage into expiration period, so if this number gets bigger, so this becomes negative and we will not realize anything. Why we are doing this? Understand this thing, net operating loss. The moment the net operating loss is below this calculation, allowed net operating annual net operating usage into expiration period, we will stop writing down our DTA. I hope this is clear. And the closing thoughts on this is that writing down the DTA may sound like a mechanical accounting step, but it actually has a very deep valuation implications. So first of all, it affects goodwill on the balance sheet, and second, it affects the effective tax rates and projections, and third, the cash flow in the acquisition method. And this one thing can break your post-deed valuation accuracy. So that's why it's important to understand these things. All right, so let's move to question number 11 now. I hope this was clear. Uh, so just remember this thing that once your net operating loss or your allowed net operating loss usage exceeds the net operating losses, you stop writing down the deferred tax assets. And deferred tax assets are created because of the net operating losses which are carried forward. And deferred means future, and asset is something which actually helps us to generate more revenue. So let's move to question number 11 now. Question number 11 is what's a section 388H10 election and why might a company want to use it in a merger and acquisition deal? And I will explain this economics. I will explain the economics, the mechanics, and the party's incentive, practical effort, and financial statement. So, one line definition of of this concept is that a Section 388H election lets the parties treat a stock sale as a deemed asset sale for U.S. tax federal for U.S. federal tax on purposes. So legally, the buyer acquires stock for tax purposes. The parties elect to treat the transaction as if the target sold its asset at fair value and then distribute the proceeds to its shareholders. And the result, in result, the buyer gets stepped up tax basis in the target's asset, and the seller recognizes tax consequences as if an asset sales occurred. 300 section 338, and when it's used, that's another question. So practitioners most commonly use 388H10 election in two contexts. So sale of S corporation or targets whose tax attributes flow to owners, and where buyers and sellers agree to the election, and sales of wholly owned subsidiaries of a consolidated group where seller parents and buyers jointly make the election. So why the buyer want it? So what are the economic drivers? If you There should be a question. So why are we doing this? This much stuff. I mean, this much trouble. Why are we taking it? From a buyer's standpoint, so buyer primarily the buyer gets a step up on in the tax basis of acquired asset, which means that the buyer can depreciate or amortize the stepped up basis for the tax, producing larger tax deductions in the future and lowering cash taxes, and it actually also improves the tax shield accelerated payback. Means that increase in depreciation or amortization front loads tax shield, and which is helpful when buyers value early cash flows. And also it makes cleaner purchase price allocation. So buyer can allocate purchase price to tangible and indefinite intangible assets for tax, which can be more beneficial when leaving value as a non-deductible goodwill for the tax purposes. And also, this actually the potential to neutralize the built-in tax liabilities. It actually also benefits the buyer in to neutralize the built-in tax liabilities because the target is treated as selling its asset and recognizing gains. So Target is a company which we are acquiring. So Target will be treated as selling his asset and recognizing gain, and certain tax attributes and timing difference get reset in a way that can be advantageous. And because these benefits actually increase the buyer's post-deal cash flow, and buyers are willing to pay more where 388 section 388 338 H10 election is available. And also, if you think from the seller's perspective, why the sellers would want to uh, sellers might agree and for the trade-off is because the seller's issue when the sells its company or its assets, the seller is going to have issues like higher tax cost on demand on deemed asset sale, possible double taxation and compensation by purchase prices, and also the complex tax compliances also the seller might face. So, okay, so think about it. So, higher tax cost on deemed asset sale means that an asset sale, which often generates more taxable income, and the gain is when the gain is realized at the target level, this means the seller might have to pay taxes, higher tax on a deemed sale asset. Second, there is a possibility of double taxation, which means that for corporation, for a corporation, an asset sale taxed at corporate level and then distributed to shareholders might trigger double taxation because we have paid the taxes and then we are paying to the shareholders, and then shareholders are also paying the taxes. This means that there is going to be double taxation. When you think about it, compensation by purchase price, so sellers typically negotiate a higher cash price because the election increase their tax burden, and the buyer can be expected to pay some premium reflecting the present value of the tax shields it obtains. So the seller captures part of that premium also. So if I am selling a asset which is going to benefit the buyer, then I will take into consideration that any benefit which buyer might be having. So I will also that take that into consideration, and it will help me with negotiating at a higher price. So compensation by purchase price also, that might be troubling the that might be a trouble for the seller also. And because of complex tax compliance, the seller must accept the administrative complexity and potential state tax consequences. And that's it. The 338H10 section actually benefits both the seller and the buyer. And so, practical considerations and pitfalls, if we talk about it, so state and local taxes, some states do not follow federal treatment, and state taxes can reduce the value of the election. And consider multi-jurisdiction targets also. So, second is that the election requires specific forms and consents, timing and documentation matters. So the tax council must prepare the proper election statement, and the deemed sale can affect carried forward attributes. Parties must model and negotiate accordingly for that. And because tax amortization differs from book amortization, the buyer will record deferred taxes that affect future earning volatility and cash flow timings also. And typically, purchase agreements include representations about taxes, purchase price adjustment, and indemnities to allocate tax risk and post-closing adjustments. So if a buyer's valuation gains from step up are large, the sellers has bargaining power. If buyer has unique synergies, the seller may get less for the step up value. And in when we talk about 338, so practical negotiation points which occur, so how buyers and sellers split the value is, buyers may often offer to pay more, pay some part of the present value of the tax shield maybe, or the sellers often seek gross up clauses for incremental taxes caused by the election. So basically, so bottom line is that the section 388 is the legal stock sale. How do we get it? The so section 338 is actually the legal stock sale plus the tax treatment of the asset sale. So the buyer gets tax basis step up, and the seller bears associated tax consequences. And it relocates economic values also. Uh, so the election creates tax shield for buyers that improve cash flows, and sellers typically extract some of that value, higher prices at higher prices. It's negotiated tax tools. It uses, I mean, it uses when the step up materially justifies complexity and when both buyer and seller can accept the tax consequences. And it always involves tax counsel early. So state tax timing and entity type specific material, it affects the outcomes. So I hope this made sense. And previously also I have discussed that these are advanced questions. So these are going to be difficult for somebody who is new to this field. I think there is a lot of homework that we need to do before uh, before we start one more time. So after the merger and acquisition, the LBOs, we actually had to prepare the leverage buyout series. But I think that it would be a good option and a good. It would be better for all those who are learning this, that we first prepare a summarized keyword definition summary kind of thing. So just go through this. Just read it out. The 11th, the explanation given in the question, and then we will move to next question. So, all right, so let's move to question number 12 now. So, question number 12 is, what is an exchange ratio and when it is used in merger and acquisition deal? So, an exchange ratio is a method used to determine how many shares of the acquiring company will be exchanged for each share of the target company in a stock-based merger or acquisition. Instead of fixing So basically, instead of fixing the transaction value in dollar terms, so the deal is structured based on the fixed ratio of shares exchanged between the buyer and the seller. And this is what a stock-based merger and acquisition means. So there are two types of exchange ratios typically. So there is a fixed exchange ratio and there is a floating exchange ratio. So in a fixed exchange ratio, the number of shares the seller receive is fixed actually. And the dollar value of the consideration will fluctuate based on the buyer's price at closing. And this fixed exchange ratio is actually favored by the buyer if they believe that their stock might decline before or after the transaction, as it locks the number of shares issued. And this is very common practice that if you are acquiring a company, that company share are going to fall, and if you are buying a company, that company share are going to rise. But it will depend on what does the market makes out of it. If it's a accretive or a dilutive, if the market thinks it's accretive, the stocks will rise of the buyer. If the market thinks it's going to be a dilutive, so the stocks of the buyer guy are going to fall. And accretive and dilutive we have discussed previously. So if the buyer believes that the stocks might if the merger acquisition is dilutive in nature, so they will try to push for the fixed exchange rate, and that's why it's favored by the buyer. And if when we talk about the floating exchange rate, this means that dollar value of the consideration is actually fixed, but the number of shares issued changes depending on the buyer's share price before closing. And this is actually favored by the seller. So if they want to ensure they receive a fixed dollar amount of their shares regardless of the stock price movement, this does make sellers this makes does this is actually favored by the seller, and this does makes also sense for the seller's perspective. Now think about it. So if I'm selling something, I would want to sell it for more, and if the buyer wants to buy something, so the buyer would want to buy it for cheap. So I would want to sell it for more money. The buyer would want to buy it for less money. So everyone is looking for their interest. So that's why there are two types of exchange ratios: fixed exchange ratios and floating exchange ratios. And in floating exchange ratios, the dollar value consideration is actually fixed. So let's assume that one for $1 million, you are the seller will be getting stocks worth $1 million. If the buyer's value of share reduces, if the buyer's number of the share values reduces, this is going to be more number of shares. And if the seller's number of if this I mean if the buyer's number of shares actually reduces, this is going to be yes, the number of shares will increase, and this will actually favor the seller because they will get more number of shares. And in future, if a merger is acquisition is happening, so it's it's actually kind of market conception. It's a concept in the market that in future, yes, the merger and acquisition, the company will somehow try to try to take advantage of all the factors in the merger and acquisition. The synergies are going to be helpful in the merger and acquisition. All the other factors are going to be helpful in the cost synergies, revenue synergies, everything is will come into play, and the company will start to grow up. And even initially, the merger or the deal might look like dilutive, but in future, the deal, when everything settles down, the company starts to perform good. And okay, so when does a company uses an exchange ratio? So companies use exchange ratios in all stock or part stock merger and acquisitions to simplify valuation alignment, or to share risk between buyers and sellers, or to facilitate mergers of equal, or to avoid cash constraints. And the strategic implications is that from the buyer's perspective, the buyer often prefers a fixed exchange rate when they expect your stock price to fall after the deal announcement. So this way, even if the stock prices decline, the total dollar value paid decreases. And in a if seller's perspective, think about seller's perspective, sellers prefer floating exchange rate because they expect the buyer's stocks to rise, and ensuring they capture the full dollar value promise that signing, regardless of share price volatility. So if they have given, so if they are saying, so fixed exchange rate is actually it's fixed exchange ratio from the buyer's perspective. They are think about it. So if I'm saying that I'm going to give $1 million to the company I'm buying, so this means that if initially the $1 is for 10, if one stock is for $10, and after acquisition the stock value falls, so the seller will be also in the same pit along with the buyer also. So the buyer prefers fixed exchange ratio, but the seller prefers floating exchange ratio. So they would prefer the fixed dollar value, and the buyer will prefer the fixed number of stocks. I and yes, I think that there is no confusion in this question. And this was pretty much simple, but it actually involves a lot of deep thinking. And in advanced questions, yes, all the advanced questions in merger and acquisition, and also merger and acquisition, it's very hard to find merger and acquisition analysts, and they actually have a very deep understanding. I hope this is clear now. So let's move to question number 13. Okay, so question number 13 is walk me through the most important terms of a purchase agreement in a merger and acquisition deal. So, in a merger and acquisition deal, and when we specifically talk about purchase agreement, which is also known as a definitive agreement, so what does a purchase agreement does? So it actually legally binds the contract that govern the sale of the business. It actually sets forth the term, rights, and obligations of the both the buyer and the seller along once the transaction closes. And while these agreements can be lengthy and complex, so several key terms consistently form the backbone of any merger and deals. So those terms are actually first the purchase price. The second one is the form and consideration, the transaction structure, treatment of options and equity awards, employee and management retention, reps and warranties, no shop, go shop clause. Okay, no shop, go shop. This is important. We will discuss about it when we will reach that point. So first point is purchase price. So purchase price specifies how much the buyer is paying for the target company. For public company, this is typically stated as a per share price, while for private companies, it is usually a total enterprise value or equity value. Uh, the agreement, the agreement may also include price adjustments. For example, based on working capital, debt, or cash levels at closing. So, and why it matters? Because the purchase price determines the ultimate economic outcome for both parties and often interacts with other clauses like earnout or contingent payments. When we talk about the forms and considerations, so this actually defines how the buyer will pay the purchase price, means the currency of the deal. So typically it includes cash, stocks or equity, debt or seller notes or earnouts or contingent considerations, which means additional payment made if the target achieves specific future performance goals. It matters because the structure impacts risk, taxation, and post-closing ownership. For instance, all cash deal transfer market risk into the buyer's risk, while stock deals share the risk between both parties. So we have just discussed about it. So what does a stock deal and what does an exchange ratio means? So forms of consideration, whether it's stock, cash, debt, or a mix. Okay, so and after the third point here is there's a transaction structure. So here the structure actually determines what exactly is being purchased and how the taxes or liabilities are treated. So the common structures actually include stock purchases, asset purchases, and section 388. So section 388. Stock purchases, asset purchases in section 388 H10 election. So stock purchases is that the buyer acquires all of the target shares, gaining full control of the asset, liabilities, and contracts. Asset purchases means the buyer acquires selected assets and assumes specific liabilities, often used to avoid unwanted obligations. And 338H means a tax election that treats a stock purchase as an asset purchase for tax purposes, and it's beneficial for buyers seeking a step up in tax basis. Why this matters? Because the structure impacts legal ownership, tax consequences, liability or exposure, and integration complexity. And when we talk about the treatment of options and equity awards, so this section details how outstanding options, RSUs, and warrants held by the target's employees or management will be handled. So this is assumed that the buyer converts the options into equivalent buyer company options. Cashed out means employee receive cash. Uh, the employees receive cash for their vested options at closing. So this means that if you have been an employee who's actually having ESOP options, so those will be cashed out or those will be cancelled. Unvested or out of the money options may be terminated. So treatment of options and other equity awards, which is given to the employees by the seller or other stock or the other stakeholders by the seller company or the company which is being acquired or the target company. So this is how this actually is an important term, and uh, you actually need to look into all the possibilities when a merger acquisition is being done. So before the merger and acquisition does takes place in practice, it takes place mentally first. So this affects employee retention, deal valuation, and post-merger equity dilution, and it's especially critical in tech or growth companies where equity compensation is substantial. That's why treatment of options and equity awards is important to look into. Employee retention and management, employee and management retention. So the arrangement specifies whether key employees and executive must sign new contract or retention agreement, and this may include when a company acquires another company. So this may include non-compete or non-solicit clauses to prevent them from joining competitors or poaching staff, or retention bonuses or stay agreements to ensure smooth integration. Uh, why it matters is because retaining critical talent is often essential to preserving the target's value post-acquisition. Without these provisions, the buyer risks losing key personnel immediately after closing. And this is employee and management. And most of the times, when you see in news and other things, social media or anywhere, when a company acquires another company, they actually uh, fire all the management and they bring in their new management into the company. But still, if there is, I mean, the key management does always stay with the company only, and employees, uh, when if the company is in retaining the employees, new contracts are comes into play, and the buyer often log in critical talent. So the sixth point here is representations and warranties. So there are statements of fact each party makes about their businesses. I mean, the seller typically makes reps representatives regarding its financial statements, legal compliance contracts, IP litigations, and ownership of assets. And the buyer may also make reps about its ability to finance and complete the deal. If any of these statements are found to be false or after closing, the affected party may seek indemnification or other remedies. So representations and warranties allocate risk and liability and between the parties and serve as a foundation for both for post-closing protection. And wraps and warranties, when you're looking at a merger and acquisition deal, always look at wraps and warranties. All right. So no shop or go shop. So these are the clauses whether the seller can seek or consider other acquisitions after offer after signing the agreement. So no shop, these clauses actually. So let's discuss about the no shop and the go shop. So no shop means that it actually prohibits the seller from soliciting or negotiating with other potential buyers. So this favors the buyer as it ensures exclusivity. And go shop mean it allows the seller to solicit other bids for a limited time after signing a common private equity led or auction situation. So this actually favors the sellers as it can help ensure the best possible price. And why it matters is because this provision balances the deal protection from the buyer for the buyer and against the seller's fiduciary duty to maximize shareholders' value. So if you are selling your company, if there are your shareholders, it's your fiduciary duty to maximize your shareholders' value, and especially in public company transactions also. So the additional key terms also include the closing conditions, which define most which defines actually what most occur before the deal closure. Example, regulatory approvals, shareholders vote, and all. Indemnification also you might have heard of in a merger acquisition deal, which means so indemnification specifies how losses due to breach of reps and warranties are handled. Termination rights and fees, outlining the circumstances under which either party can terminate the agreement or whether a breakup fee is applicable. And covenants. And covenants are the obligations each party must fulfill before signing and closing. Uh, it's just a fancy name for terms and conditions. So the bottom line here is that the purchase agreement is the cornerstone of any merger and acquisition deal. Purchase price agreement. It formalizes the economy. It allocates the risk and set up a legal framework for the transaction. And each term actually plays a critical role in determining the financial outcome or liability exposure towards liability and the success, whether the post merger would be a success or not for both buyer and seller. So and so if I summarize it, so purchase price means that how much is being paid. Form of consideration means in what form the payment would be made, cash, stock, or debt, or a mix. Transaction structure means what exactly is being purchased and how it is taxed. Treatment of options and equity awards means what happens to the employee equity awards. Employee retention means that how will key employees and management will be handled. Representatives and representation and warranties means what assurance are made about the business. That what assurances are made about the business means from the each side. See, if you are buying some business, so there are some representations and warranties which both the parties of post merger they assure each other that those will be made. So they actually have to look in though they actually have to fulfill their representations and warranties. No shop or go shop means whether or not the seller after the sell. I mean, once the merger starts, can the seller pursue or okay? So once the offer is given to the seller by the buyer, so can the seller still pursue other offers? So it's either it's a no shop or a go shop. So I hope this is clear. And let's pause today's video here only. These advanced questions are actually taking a lot too much time, and I do not want to make bigger videos. So we will discuss the other questions in later on videos. But I will try to make it as clear as possible so that for the understanding purposes, you do not have any doubts. All right, thank you. If you have learned something of value today, kindly subscribe to my channel and I'll see you soon. Thank you.